All right. Ajay Kaul, Chief Executive Officer at Jubilant Foodworks, joins in to take some questions after numbers came through yesterday. 1,016 on the stock. It's off some 15 rupees from the day high. Ajay, good morning. Prashant this side. Simple question. What happened?
Good morning. How are you?
It was a shocker of a number yesterday.
No, nothing happened. Actually, to us, I think our growth story is still intact, and I will dwell on that in a moment. But I think 7.7% same-store growth, which people are not really, ready to hear from, from us, given our past track record, has surprised a few people. But we have been telling it for a long time that we could see it coming. If you see even 4 quarters back, when we probably clocked 25% same-store growth in that quarter, we did say that, as far as growth in new customers is concerned, and as far as growth in frequency of consumption is concerned, we could see that it was gradually coming down. And it progressively kind of kept coming down over the various quarters. Last quarter we did 16%, and this quarter was 7.7%. But having said that, I want to actually, move over to a much larger story, which is the growth story, and which is what, people probably are banking on Jubilant Foodworks for. We had said at the beginning of the year we will do 90 new stores. We upped it to 100, we then took it to 110. That was the optimism, and we actually ended up delivering 111 stores. Our forecast for next year, our guidance for next year is at least 125 new Domino's stores, at least 18 new Dunkin' Donuts stores. To me, these are all, call them the harbingers, call them things which tell you that how intact the growth story of India is, and as far as Domino's is concerned. Last year, while it was a tough year, you are right, especially towards the end of the year, we still ended up spending around, 190 crores on capital expenditure. A lot of it, of course, went into new stores, but a substantial 50 odd crores also went into modernizing. In fact, 2 new factories we set up, one in Mumbai and one in Kolkata. Now, these are factories where we invest 20-30 crores of rupees each. Why? Because we are trying to look at business from the next 5 years, 7 years perspective. As we move into next year, we are planning to spend around 70-75 crores in building few more commissaries. There's one which we have created in Chandigarh in Q4, which was a landmark one for us because it was the 5th one after a long time. We spent around 10-12 crores, again looking at the huge potential in North India. We're going to open one in Nagpur during the course of this year, one in Hyderabad, one in Guwahati, a little smaller one, and most importantly, a huge mega facility, probably 2.5-3 times the size of our existing facility in Noida. Now, why is all this happening? Because we can see that we can open at least 125 new stores in Domino's year after year. The Dunkin' story is separate from this, which has its own trajectory. So all I would urge you to do is that, yes, a shocker, I'm taking that statement because we are not used to 7.7%, but we do believe, the optimist in us tells us that there are stimuli being thrown by the economy, by the government. Our own marketing interventions are also going to play a role, for a pure discretionary impulse purchase kind of category where outlay is only around 300 odd rupees. We don't see consumers can hold on for too long, not to kind of spend on our category. So we should spring back into double-digit same-store growth soon. Our guidance for this year, is around, should do at least 10% is what our guidance is. And we are hoping that, the economy revives fast and we spring back. But as far as new stores, entering into new cities, growing in existing store, all that story is intact. And we are very, very upbeat and optimistic about it.
The reason I think people are shocked is because one thought that yours is not a business which is going to be affected by cyclicality. People thought it's immune to cyclicality in the economy. That's not correct, right? I mean, if you look at how SSS growth has panned out over the last couple of quarters, I think that argument is now dead.
That argument is surely dead. Even in the year where Lehman Brothers collapse happened, in that year, you may recall, we did 6% same-store growth. That was our worst year out of the last 7-8 years that we have had. So, it is not totally bereft, or it's not totally isolated or insulated from, changes in the macro environment. And in this case, more so because Lehman Brothers was still a global phenomena, and, this is more closer to home, and so on and so forth. If you were to look at the industry numbers for a moment, and you will be surprised to see that, probably if you take only the large players, into the equation, it's probably a sub-zero, it's a negative same-store growth number. So while we can draw joy out of the fact that the industry is negative and we are still 7.7, that doesn't excite us, honestly. We look at our own performance. It is affected by macroeconomic indicators. We have been saying that for the last 4 quarters now. It's coming, and it is coming, and it has finally come. We hope it won't stay for too long, but even if it were to, we are insulating ourselves by saying that, the real story is actually long term. The real story is adding more and more stores, and that story doesn't change at all, trust me. The potential which we see, we have entered in the last quarter places like Yamunanagar, Warangal, Satara. Now you may argue what kind of places are these, but if I share with you some of the sales which we are doing there is outstanding. So all I'm saying is the growth story of India, especially in the hinterland and the big cities included, is intact. And we will keep entering. For example, next year we plan to enter another 15-20 new cities. We have mapped out the next 70-80 cities which we can enter in India over the next couple of years, 2-3 years. So that story is very much intact. As far as same store is concerned, it is an important number, no doubt. We have thrived on it in the past. We do believe it's going to come back. May not go back to the 20s and 25s and 30% levels soon, but we do believe that it will get into double digits, sooner than we think.
If the macro stays the way it is for the next 2 years, you think you can still bounce back to double-digit growth? Or you think it's entirely dependent on the macros?
I would say it's 80-90% dependent on macros. It is also dependent a bit upon, I would say only 5 to 10% on, as we grow, we open more stores, they tend to kind of, cannibalize a little bit from our existing stores, especially in the large cities. But 80-90% is macroeconomy driven, and to me it is an irreversible. When your GDP is growing at 5.5% still, it has to translate into discretionary spend of with a multiplier sitting there, and it will further translate into a pure impulse category, which is ours. 300 rupees, 350 rupees is what the average ticket size is. It has to translate into all that. Now, I think there is something which has prevented the consumers in these last 3-4 months to kind of hold back, but it is going to change. We are very optimistic about it. Why we are giving a number of 10%, which you may argue seems like a bit conservative, is because in any given year, our dispersion of same-store growth has not been so high. Even in the years where we did 30% same-store growth, the range was probably between 35 and 25, which is kind of, statistically insignificant. But in this last year, we started at around 25% same-store growth, and in quarter 4 we did 7.7. So dispersion is far higher, and that actually, surprises a little bit, I'll be honest. So we believe recovery may take a bit longer time, but obviously there is a lot of marketing intervention which is residing with us, which we will do. As a company philosophy, I want to spend a moment on telling you that how we invest behind the brand and people brand in tough times. We did that during the Lehman Brothers time also, as much as we did last year. Later portion, and clearly we will do it this year, is we upped our marketing spends last year, advertising spends. We also went ahead with our new positioning in a tough year, which was Ye Hai Rishton Ka time, because we believe that's what we are, that's how we can get emotionally connected to our customers, and the consumers have resonated with this kind of positioning. Similarly, the kind of monies which we are putting behind creating bench strengths, leadership strengths, keeping of course future in mind, the amount of money which we are spending on training, we have almost doubled our training budget last year. This year also we will do the same, because as we come out of the woods, as I said, sooner than later, we will hit the road running faster than any of our competitors, and the lead is only going to increase. As it is, we are the largest MNC QSR brand in the country, we are the fastest growing QSR brand in the country, and there is no reason why we won't improve our lead over our opposition.
Okay, so you're a CEO who's bullish on growth rebounding, and that's fair. You're betting that growth will come back sooner than later. My question is, what if that assumption is not correct? What if we are in for a very protracted phase of slowdown? And the right thing to do at this stage would be to consolidate your profitability, consolidate your brand, franchise, and not expand. Because if the slowdown continues, demand will be subdued. You're expanding into Dunkin', which will continue to require cash. And, you know, input prices are quite volatile, Ajay. Humor me on those points for a bit. What if that is true?
No, you know, we are not getting bogged down by this temporary blip, honestly. While we have around 110 crore cash sitting with us, we are debt free. We generate enough cash during the year which funds all our capital expenditure. But a temporary blip, you know, even if, let's say for a moment I were to buy your argument that it will continue for a bit longer, but, you know, we are so optimistic about the growth story in India. You know, we have opened 111 stores last year. I would say 98% of those stores will give their paybacks in time frames which is acceptable to us, to our board, which is less than 3 years. You know, some of the stores have amazed us. They are opening at places, as I just said a little while back, Satara, Yamuna Nagar. You may argue what kind of places are these. Fantastic performance coming from these stores. So we do believe that the same store growth pressure, a bit of, you know, should we get into the consolidation mode, could be one way of kind of looking at your strategy. But we are not overawed by what is happening there. We are more focused on building capacities for future, building infrastructure for future, creating stores or distribution points for our consumers, entering into the hinterland. As our marketing fund remains kind of stable, the penetration obviously goes into that much more into the country, into the hinterland. So our strategy is we have to grow. There is a huge potential in India. It is lying there, you know, sitting for us, and we have to go after it. But it's not mindless. You know, for example, our guidance of EBITDA percentage for next year is still 16.5%. We are obviously, you know, very, very sensitive to what our stakeholders, what our investors, what you and, you know, the business community expects from us. So never are we going to kind of lose our sight from that. We are always going to be like hawks watching our EBITDA numbers, return on sale, return on capital employed. But clearly the focus is going to be on growth. And that is a ball which we are not going to take our eyes off.
Good to hear that, Ajay. Thanks very much for your time. Hope things pick up soon for you and everybody else. Everybody is in the same economy, in the same boat, I guess. Thanks very much for your time. Great to have you with us here. Good luck.
Right.
Let's take a very quick break. We're back in 2 minutes. Markets are looking up, but not as up as they were about 10 minutes back. We're back with that and more in a bit.